A shadow bank is a non-depository financial institution that's exempt from normal banking regulation. These firms are responsible for creating tens of trillions of dollars in debt and equity capital across the global financial system. Join me as I take the esoteric power of capital creation from behind the closed doors of Wall Street to your Main Street. I'm Ben Summers, and welcome to the Shadow Banker's Secrets podcast, based on the book I wrote by the same name. Today, we're joined by Carlos Lowenberg. He runs a successful RIA that he designed to serve his business consulting clients, particularly with respect to their exit planning needs. Carlos, it's been a while. It's great to be with you again. Since we last spoke, how has your business evolved? How have you been navigating this relatively tumultuous climate?
Well, good to be here again and speaking with you. And it's been a while since we spoke, but what's changed or what's been happening for us is mostly the exits that we're working on are a little bit larger, and some of them have been pushed back due to the economic circumstances right now. And I don't think that's all bad for folks. I think people are rebuilding, but that's really been our focus the last 6 months or so since we've spoken.
If you recall, when we last spoke, what connected us was you were looking to grow, right? Always looking to grow.
Yeah.
And I think acquisitions was one of the approaches that you were looking to take. And then, as you probably recall, we're an investment bank. We've got close to 1 million high net worth individuals in our ecosystem that we just haven't served because they're just not what we do. That number wasn't so high all the time. We were about 130,000, and then we effectively partnered with Intersection Capital, and that took that number, from 150,000 to again 1 million, and so that's just too much money to sit on the sidelines. So what we were doing is saying, all right, who in the retail space can we partner with effectively to send these prospective clients to? And the challenge is philosophical alignment, right? And I don't recall the nuances of our initial conversation, but I do recall that there was at least substantial potential for philosophical alignment. And what I mean by that is everything we do, if you recall, is quant-based. So if you look at a complete market cycle worth of data, means you got to look back to at least January 2007 or earlier, and you account for all 4 statistical moments of risk, that will tell you what to allocate to. The only other consideration are liquidity constraints of the allocator, right? And so the people that are in our ecosystem have been taught to view the world through that lens. Okay. And when we're referring them to retail advisors, the only catch, like the obligation effectively is that allocation decisions are made per that perspective. Their money will be put into what is objectively best. And what you find is when you do that, portfolios start looking a lot less 60-40. Yeah. And a lot more institutional. So instead of being like, 60-40 and 10% in alts, you get like an institutional portfolio where you're 60-70% in alts. And when I say alts, I'm not talking about some shitty fucking mom and pop real estate fund, right? Like institutional grade stuff where you've got 7-figure minimums. Yeah. So then the next objection becomes, well, if I'm dealing with retail people, how's that even possible, right? And that's where the fund of funds comes into play. So like, look, you're probably getting 1% management fee in your stuff. So what we'd say is you create a fund of funds, and now you've got your entire client base aggregated into this alternatives portfolio, regardless of what percentage it constitutes in the overall scheme. And now this fund of funds is more than able to reach the minimums that these institutional grade funds have and establish whatever level of diversification is prudent. You're no longer constrained by the individual financial wherewithal of a retail investor. It's aggregated into this fund of funds. Now, the benefit, obviously, of the retail advisor is you get paid fees on the fund of funds. So now you're effectively triple monetizing your firm without growing your client base at all, right?
Yeah.
Which is, of course, the effective going rate if you were to sell out. So when we last spoke, I think the conversation went in the direction of went well, right? And we wanted to establish some intuition of some visceral response to these numbers, right? And I'd asked that you submit a full market cycle worth of data, probably monthly total returns for any portfolio that you've got some familiarity with. And the point of this was not to shit on it or to praise it. It was just to say, look, this is the accurate expected return. Here's the maximum drawdown duration. Here's the Modigliani measure. Here's the omega ratio. Just so when we say, hey, here's an omega of 2.7, that means something, right? Just to, again, provide a little bit of concrete or substance to these relatively abstract ideas. And that's kind of where things were left off. Does any of that ring a bell? No.
Yeah, a little bit. Yeah, I guess you expected me to shoot you guys a portfolio, but I mean, if you look at our portfolios across the board, I mean, we've been in sort of been in passive ETF risk managed portfolios for the, like most folks are
sure
having the same risk, just reducing fees a bunch on that side. And we've got some institutional managers doing some stuff for us, but that's the two things that we're doing. Our clients are pretty good size. We're dealing with $20 million portfolios. And so, and generally they're older folks. They've exited their company, they've sold, well, we got a $3 million sale happening right now, but generally there's 20, 30, 50, 80 million in new assets to manage when we walk through an exit. Right now, frankly, we're doing a lot with opportunity zones to preserve taxes, right? We're rolling clients into things that preserve taxes, because that's a 22%, 21%, depending on what state they're in, tax savings off the bat. So most of these businesses have no basis when they sell. And so that's really what our focus has been recently. I do remember our conversations, and we have to move more into an institutional type of environment for our clients since they're getting so big. And we've done a little bit of that. We've opened up with a new custodian at Interactive Brokers to make that more possible. We've got some hedged and leveraged equity that we're doing that's lower risk than what most of our portfolio is, and getting a nice yield. It's leveraged, but it's a nice yield, and that's what we've been focused on recently.
Yeah, understood. If I recall, you had about 30 clients and represented about 150 million AUM.
Yeah.
And as you said, like, you were really focused, your niche was helping business owners exit, right? And then transition into passive portfolio.
Yeah.
Yep. And I don't necessarily remember that point being precisely articulated, where you were already motivated to move into a more institutional looking allocation models. But that's certainly reason to expect that prompted potential alignment there, right?
I think so. I mean, it's there's a firm here in town that I was talking to at the time as well, that sort of runs a an income portfolio that's got 12 different, 10 to 12 different investments in it. It's had 2 down months in the last 75 or 80 now months. Yep. And nice, 8% return. I mean, nothing massive, but an average return of 8% over that time frame, and no volatility to speak of. So that's sort of where we're headed with some of this stuff. I mean, liquidity, that's not liquid like public markets generally are, but it's got a lot of it's an Austin-based company, so it's easy to track. And
sure.
I've watched them for a long time, and known them for a long time, and probably 10 years. And so it takes me a while to pull the trigger sometimes.
No, I get that. I mean, that's part and parcel with this industry, I think.
Yeah.
So kind of to that, addressing liquidity for a moment, like that does bring up a good point. And I'm sure you've seen me say this before, we probably spoke about it, but when it comes to liquidity, right? Like if you've got a client that has a liquidity horizon of less than 24 months, they shouldn't be in capital markets anyway, right? And so what value is the liquidity if at the time the liquidity is needed, their portfolio is down substantially, right?
Sure.
So anyway, but I don't think that's terribly a terrible issue with you, again, because most of these people who are exiting their business are not necessarily looking for, they're not cash strapped, right? They've got a substantial, they've got patient money, right?
Right. That's right.
Yeah.
In most cases, every once in a while, you meet somebody who's got bigger plans than money. Yeah.
That's a common theme, I think, sometimes.
Mm-hmm.
But yeah, and again, that's one of the challenges I think that the retail market presents in general that you probably don't face as much as most people, is like you'll get a new client, and I hear all the time advisors are like, yeah, I got a new client, and they said they were good being, with a 5-year horizon, and they come back 6 months later, hey, I want to buy another house, and I need, that wasn't the fucking plan.
That's how we discussed before. Yeah.
That's how we discussed before. So yeah, obviously I think you need a little bit of additional liquidity just to sort of manage that kind of thing. But again, you probably don't see that a whole lot with amongst your client base.
I mean, you do. It depends. I mean, somebody who's paid themselves $500,000 a year for 10 years or the equivalent, and then suddenly has $40 million does tend to spend more than they think they're going to spend. They tend to do things the first 2 to 4 years, depending on how old they are, that they said they wouldn't do. Whether it's an airplane, a second, third house, you name it.
Yeah.
Apartment in Paris. We've seen it all,
I have no doubt. Yeah.
Yeah.
So what I really want to accomplish today is allow you the opportunity to sort of, I don't want to say plead your case, but to present yourself, and we'll cut this segment out, right? To my audience of high net worth investors, and demonstrate that either we are already on the same page with respect to risk management and portfolio construction, which we're probably not there because we had just 1 or 2 conversations previously. It's been a while. We haven't done much.
Yeah.
But at least show that we're on that path, right? So,
I mean,
go ahead.
I get that, we are not. So I guess I wish I would have understood this better. We are not looking for retail investors as clients.
Okay.
I mean, we have a pipeline of businesses knocking on our door to help them with this planning. And where we help, I mean, our typical clients making $3 to $10 million a year. We meet them. Sure. And they own a business. Hopefully they're keeping a lot of that. Yeah. But they're paying a lot of it in taxes. And, it's common that we come into it. So I mean, if I was going to pitch, I would say, look, if you had a business with 25 100 employees, I could add $1,000 per employee to your bottom line immediately. And probably within 2 years, another $3 to $5 million put in your pocket. And then when you're ready to exit, we can make that a tax-free exit.
Yep.
That's, our clients are severely loyal because of that.
Mm-hmm.
And some of them are serial entrepreneurs. But what I'm looking for is to bring to those clients the best of the best in money management, the best of the best in tax management, family office management, and those things. I really know my business on the consulting and tax world. I'm an RIA, I own an RIA, and we do a good job there, but it's not all in-house. You know, we hire managers to get some of the things you're talking about, whether they're institutional or what have you. And that's really been a formula for our success. Is we're focused on wealth creators, generally founders of businesses. They're in their 50s and 60s. Some of them are software. We're working on a software exit right now that should be 55 to 65 million. We're trying to niche down. We're not trying to expand our market. We're trying to niche down and specialize even more in certain industries. So I'm not really somebody who will get out and shout from the rooftops, "This is what we want," because we haven't, you know, my money management business is our smallest business, and the consulting business and the tax business are much larger.
Yeah, if I recall, that was your marketing niche, right? Like, it's the business consulting side. And the evolution was that you've got the RIA that ultimately manages that money after the exit, but the focus is on the business consulting.
Yeah. It was only because the RIA had to open up, number one, to appease my clients saying, "You need to manage my money," and me saying, "I don't want to." And for 5 or 6 years, I said, "I don't want to." And then I saw what they were getting, the kind of advice people were getting out there. I thought, gosh, we need to be helping these folks out, because, you know, there's just you know, it's most advisors are not advisors, they're just salespeople. So
absolutely. Yep.
So we helped out there, but I mean, our clients were corporate, you know, banks at the time and small companies, and that's who we did the consulting for. And now it's more just, you know, small to medium-sized companies. I say small.
Yeah. Yeah. I mean, not exactly our experience, but similar, right?
Mm-hmm.
Like, so I completely can empathize and can appreciate that you don't want the run-of-the-mill retail client heading your way. So let's then move the conversation to highlight the things that you do want to focus on. And then if it is the money management that you're looking to optimize, then we can talk about our perspective on money management supplementing your RIA business. Mm-hmm. And again, if we do work together, there's no reason. Like, we're literally talking about 1 million fucking people. Like, yeah. I guarantee you there are tens of thousands who own businesses.
Yeah, sure.
Right.
That's right.
Yeah, then we can happily and easily filter that out. Mm-hmm. Because it's kind of arbitrary, but we've kind of settled on that. All right, we're going to work with 10 RIAs, again, arbitrary number, right? Yeah. Ideally, we want some geographic distribution. Mm-hmm. And if there are complements and niches, then obviously that utilize that, right? So I'll tell you, like, we've probably got about 60 that we're pretty far down the road with, and you are the only one who runs a business consulting business first, right?
Right.
So what that tells us is like, all right, for all these people who are running businesses, we just take out that segment. Those guys go to Carlos. So maybe it won't be as big in terms of number, right? But it's the people that you want to work with, right? So I think that's probably a good thing.
Yeah. Yeah. No, I mean, yeah, just as long as we're focused on our niche. I mean, not very helpful to the typical retail investor.
Well, I'm not either, for different reasons. I just don't have the temperament for it. And you may not either, but
yeah.
That's it. But there are plenty of guys who are, right? I mean, you know as well as anybody that's what 99% of retail advisors are. They're just salesman bullshit artists. Like, give me somebody who's got a couple of dollars in their pocket. Let me try to separate it from them, right?
Right. Exactly right.
So yeah, very good. So I'm happy to again to continue down the road with that that paradigm in mind. We segment insofar as we're moving forward together, we segment that portion of the of our Rolodex, and that goes to you. Now, with respect to you on the money management side, I'll tell you, like, and again, you know, this is part and parcel what we talked about before, the sales guys. There are exceptions, and I got to tell you, like the guys that we're really talking to, there's some good people, right? Like they take ownership, they're smart, they're intellectually curious, they're independently minded, all these sorts of things, right? But I mean, that's obviously the minority. And so, but even they, right, are primarily motivated by growing their AUM or establishing or improving the legacy that they've got. So they've got, say, a son who wants to be a financial advisor or whatnot, right? So we just, like marketing 101, you want to position yourself to give people what they want in the terms they want. So that's why we're like, okay, right? Like, you want to see the world through this lens, we'll try to give it to you in exchange for looking at the money management world through our lens. It doesn't sound like that incentive is necessarily required for you. So where do you land on the money management side? So, you know, like, we're rigidly quantitatively driven, right? Like 60-40 asset allocation, diversification, as Warren Buffett says, is insurance against ignorance. Like, where, to what extent are you, I don't know, I hate to use the term, but say even motivated to adopt, say, a new perspective? I mean, new in the sense that it's not widely utilized in the retail space.
Yeah, no, I think that, I mean, I'm incentivized to keep my word to my clients. And so what that means is creating for them what they would create for themselves if they knew what I knew.
Sure.
It's that simple, right? So we can't turn away something that works better than what we're already doing if it does work better. You might incorporate it slowly. I do move slowly in some areas, but because you need to make sure that what you're seeing is what you're seeing. And I also know that, you know, being our size is kind of nice because there's things as an RIA that we can do that, you know, a $3 billion RIA can't, or a $40 billion money manager can't. They just can't.
Sure.
And so I always look for things where our size might be an advantage.
Of course.
And then try to take advantage of the large size too. You know, I mean, we use CNR for our big, giant, conservative liquid portfolios, and they do a great job. And so yeah, we're always looking to add, and that actually helps us diversify the business, right? The business itself has to be diversified to a degree.
Sure.
What I mean by that is if you have a, you know, there were no exits in 2008. Zilch. I take that back. 2009, 2008, we did have 2 exits. 2009, there were no exits. All the deals stopped. LIBOR went away for a little while in 2000, if you recall that. Lots of things stopped. And that happened in 2000 and, right after 9/11.
Sure.
That happened. There was one real estate closing in Austin in October of 2001. And that was mine. I bought the only house that sold that, within a month after 9/11. Believing that I was at the bottom, and so
yep.
I do feel like other parts of the business, especially just as a business person, if you can show that during a drawdown, the 50% drawdown in the 2000, 2001 era, or the one that happened in 2008 and 9, if you can show that you were less impacted by that than other people, you've built value in your business. And so just that by itself is a reason to be looking for people like yourself.
Yeah. And I'm glad you mentioned drawdown, because as you know, there are tens of metrics that are utilized to evaluate portfolios and assets. And they all do provide unique insight from one angle or another, but they can also be used extremely pedantically. But if you really care about the outcome, what really matters is, A, did you look back far enough? Did you go across the market cycle? Or 2, did you look back to 2020? And then furthermore, when it comes to what metrics to look at, taking into account all 4 statistical moments, drawdown and drawdown duration are the most important. Expected return, right? Geometric mean of historical performance, number 1. Number 2, what's the drawdown to drawdown duration, right? And then the 3rd and 4th, I'd say, are Omega and Modigliani. We can talk about that a little bit, but that tells you 80% of what you need to know, maybe 90% of what you need to know, just by virtue of knowing the expected return and then the drawdown duration, which is easily communicatable, easily measurable, right? And doesn't require much of an intellectual reach for most people to grasp.
Right.
So yeah, glad to hear you say that. You mentioned size being a potential asset, or being at least strategic in terms of your target AUM. Do you have an AUM target for your firm, or something that's I just want to be as big as I can, right? There's one firm, right?
Yeah, I mean, it's the AUM target's part of a larger target, but yeah, I mean, I think that going to 500 million makes sense. If we hit on all cylinders, that would be our target. It's not that I wouldn't want to go to $1 billion or whatever, but the other businesses within this business, which there's 4, are also growing. And so those are a little more profitable than the money management. Well, I'm not sure that's true anymore, but they're very profitable.
Sure, I get that. That makes sense. I mean, hell, just the nature of the consulting, right? Anyway, not a scale.
Low overhead in the consulting business.
Very, very low overhead there.
Right.
Yep. So, we would try, and again, this is probably a little premature, but we would try to push for a minimum $1 billion AUM target. And I think that we could certainly help provide the infrastructure you need to support that.
I'm just not going to sit here and say that, in 5 years we'll be at $1 billion. And I don't do the traditional annual goals and all that kind of stuff. Because if you're on an annual system, you wait almost a whole year before you get your act together.
Sure. Sure.
But so I don't think in terms of years, but yeah, I mean, I look in terms of benchmarks.
I get that. To be clear, what I'm not saying is, hey, Carlos, go do more marketing, right? Go get more exits to grow your AUM. What I'm talking about is the capacity to handle what we would potentially drive to you, right?
Mm-hmm. Yeah.
Because what we don't want to do is, well, first of all, there just aren't enough of them, right? We don't want to have to deal with 20, 30 RIAs, the vast majority of which are just brain damage to engage, right?
Mhm.
So ideally, we want like a handful, 10 max, where we can say, all right, Carlos is the guy. Everybody who's a legitimate business owner, right? Especially those with an exit in the foreseeable future, those are Carlos's guys. And what we don't want to say is like, oh, okay, we've sent you this, we've gotten your AUM up to, 500 million, and then you're like, you tap out, you're like, I don't want any more, right? Go find somebody else.
No, I'm not. No, that's not what I'm doing. Yeah.
Yeah, I wouldn't expect so, but just to be clear, the common theme that we see is we're successful at running our firms and businesses, and our money is way better placed inside our business to grow it than it would be to be moved externally to a passive portfolio. Like, What do you see on that front?
Absolutely. I mean, I mean, it's very rare. I mean, if you've got the 25 multiple type industry, maybe that's not true. Okay. Yeah. So if you're in software and you're making $5 million a year, but you're going to get $100 million exit, okay, yeah. But by and large, unless you're in one of those crazy multiple businesses, which I would say right now is healthcare IT, for instance, that's where the highest multiples are right now. And we've got a couple of them. But if unless you're in that industry or healthcare software related businesses, and getting rid of the VC funded things, those valuations are all crazy stupid. Then yeah, you're always going to be better off investing in your own business. And so, one of the things we talk about with our clients a lot is a no exit. Mm-hmm. Like, look, you'd be better off investing in your own company. And if all you're trying to do is, get on a boat more often and play some golf, I mean, you're going to feel better watching this thing that you understand than watching the things that we're going to do that you don't understand. Mm-hmm. So
I'd have to imagine in that scenario, the biggest challenge has to be finding management who can replace the expertise of the founder. I'll tell you that, I mean, I've been running my firm for a couple of decades, and the biggest challenge, bar none, is finding people at my level that I can directly delegate to, right?
Yeah.
How do you manage that? Yeah.
Yeah, you can't. So if you could find someone like yourself, you would they'd be your competitor.
Yeah.
You have to buy them. You have to buy them.
Yeah.
So buying them is one way to do it. Okay. So that's what some folks do. They go and they buy a management team. And private equity firms, by and large, that's what they're doing. They're identifying good managers, and maybe they find one of those companies that they buy, and it becomes sort of their platform company because they've got a good management team, and now they can roll all these other businesses up under it. And that's a great strategy when you find the right guy, but you got to find the right guys or women, I guess. The other way to do that is to create that management team. And that's a long process. It's at least 3 to 5 years. And it actually has to become your number one goal in the business, is to create the management team. And so your goal can't be growth, although you'll grow during that time and all those things. Creating the management team and making it not dependent on you, which which for some folks is hard, because some of us get in business because our egos are involved. we got in business because we wanted to right some wrongs or something, and now we're being told to step out of the way so that we can become wealthier. But that's the reality. The more you can step out of the way, the wealthier, the more business wealth you'll build. So creating that management team is, and the call I had before this was all about that. We're trying to deal with one of our entrepreneurial clients trying to create a management team in the business he's buying right now. And he's come to the realization that the guy he started with isn't the guy he's going to be able to finish with. What does he do? So, yeah, that's the key. That's the key thing. That's the key CEO job.
Understood. So when you're dealing with your clients, right, when you're engaging them during this business consulting phase, what's that breakdown look like versus just, hey, the multiples are there, I'm just going to exit, versus I'm going to buy a management team versus going to develop one? Like, where does your consulting practice generally take you with the clients that you see?
So, what I do is I generally ask them the first 40 or 50 questions that a PE firm would ask them. So if you were on the block right now, being shopped right now by an investment banker, and a PE firm showed up that was interested and got to the point where they were going to have an interview with you, I want to ask you those same 40 or 50 questions, and we're going to grade your management team. We're going to grade how important you are to the business. We're going to grade your cash flow creation. We're going to grade your how much of a monopoly you are. How much of the market you own, how much of the market's available still. All those things are what a PE firm would look at, value drivers. And like any investment, two things being equal, one's less risky, but all otherwise performance is the same. They're going to pay more for the less risky business. And business owners don't get that at first, especially smaller ones. The bigger business owners know they've gotten to 10 million. They've started to figure out a lot of their businesses is risk management.
Sure.
So we're saying, we're all the risks that we're going to identify in your business, and we score them. And that's, and generally it's management in a smaller business. And then it gets to be other things like competitors, or, how easily can Amazon take you out in some cases, right? If you're in a warehousing type of business, distribution business. So those are the things that we look at now. Software capabilities become a big deal now, right? I'll give you an example. I learned a couple of years ago that heating, HVAC companies are worth a lot more than they used to be, because they're now software, they're now technology companies. That happened without me noticing, frankly. A company like that would sell at 5 times earnings, and now they're selling at 9 times. And why is that? It's that technology, the tech-enabled business, because they're, you've got a modern house, your HVAC, or a modern, company you're building, your HVAC company's tuned into your system, and you're paying a residual usage fee for that of some kind. So, that's changed. So part of the I would call it the hierarchy of recurring revenue, and how is that created in your business. So that's moved up the chain in value drivers in the business. So it's your management team and your recurring revenue are kind of 1 and 2 right now. That's why these medical, healthcare IT companies are worth so much, right? Because healthcare is not going anywhere. IT has always been what it is. It's so great place to be right now.
Understood. So I'm not sure if I'm hearing you correctly, but at first, and this is probably me coloring the conversation based upon my experience and just the nature of how I do things. But the feeling was that management really is the big issue. And what you're saying is, yeah, it is, but it's predominantly an issue for smaller firms. And it's not necessarily overriding all the other considerations during this consulting process.
Well, that's right, because the larger firm you are, the more likely your management's in place. Businesses don't make $5 million a year unless they're celebrity based. There's some people out there making a lot, $5 million a year, but they're based on a driver in the business that's worth a lot. And if you took them out of the business, it wouldn't be. But by and large, a $5 million a year business earning $5 million a year, it might be worth, say, 7 times that, $35 million, has a management team, and has probably, in that case, let's say they've got 30 million in sales, they probably have 300 employees, and they probably have 20 people who are pretty valuable and 5 to 7 who are key and 3 people who are strategically key, not just one.
Yep.
Okay. So that's a typical business with 300 employees. 100, you don't get to 100 employees without having a management team.
Understood.
That's what I mean. So other things become as important as management almost in that
of course. Where my mind goes to immediately is Apple. And what I mean by that is Apple is huge. It's the biggest, right? But Steve Jobs, I'd argue, was Apple.
Mm-hmm.
And ever since he was replaced, Apple is running on inertia largely, right? Like, I don't know that Tim Cook has the wherewithal to drive Apple to a place that Steve Jobs did. Now, by virtue of Apple's size, you can say, not that big of a deal. We've got the inertia, we've got the management infrastructure in place, right? And it'll keep on going. But I'd have to believe that when you're talking middle market companies, right? Even if there are ostensibly stable structures in place, that to the extent the founder is still involved, he's really driving that business. Is that a false belief? Is that not true?
No, I mean, it's not always true. I mean, so you got the visionary. So the business owners that we all notice are the visionary ones, but they're not all like that.
Sure.
A lot of owners are technicians who figured out entrepreneurship. And so they started out technically doing something. I mean, like in our business, sometimes, normally somebody who's successful in the investment world is a good salesperson and happens to learn the investment world. But sometimes you meet somebody who's got an investment trap they've built and learned how to monetize it. And those businesses get much larger than the ones that are driven by visionaries, by and large, because they're engineering built and they're not as dependent on that one person's performance. They're more dependent on organizational performance, which is oftentimes as dependent on some technology or some system or some engineered solution.
That's an interesting reference, and it's directly comparable to our firm. And I'd say I don't see it quite that way internally. I'll give you an example. So with us, our role in the market is to go find asset managers who can generate objectively better performance than what's otherwise available through traditional markets, optimize that strategy, engineer the vehicle that wraps it, and then distribute it, right?
Mm-hmm.
It's all based upon quantitative standards. So you'd think it's a relatively easily system to build, rinse, wash, repeat. I'll tell you it's not, because people revert back to the mean. So for example, almost every asset manager that comes through us, there are substantial, not only opportunities for improvement, but I'd say obligations for improvement to meet the internal standards that I have fucking set. And every time I am not present in one of these meetings or driving the process like a goddamn slaver, it reverts back. Oh, we can make this assumption. This model is good enough. We don't need to research that data. It takes maybe not just a visionary, but a high level of autonomy, discipline, and standards to drive what, say, in our case, differentiates our firm and allow it to run in perpetuity. See, I have a lack of confidence that if I step aside, somebody else is going to come in and maintain the same rigor, right? So, and I can't be alone in that. I can't be alone in that.
You're not. I mean, it's and that's a problem at the highest levels. It's a problem at the highest levels, and no one understands it. And that rigor of a founder, of an owner, is not irreplaceable, but it's kind of like Peter Drucker said years ago, you've got to build a culture around your business and in your business, because culture eats strategy for lunch. And generally visionaries and owners are strategic, which is important. Strategy is important, but culture is more important. And a culture will win more often than a strategy will. Bad strategy or decent strategy, mediocre strategy does okay with great culture, but
Sure.
the best strategy does terrible with bad culture. And so, how do you institutionalize your culture? Number one, and I mean, there's a book out there called the Checklist Manifesto that deals with this a little bit, because it's a checklist culture. How do you hold people to discipline? Well, there's a list that everybody's going to be held accountable to, and that's, and having an accountability culture that's not drudgery is difficult.
Sure. Sure.
Because most of the people that that were accountability freaks weren't fun to be around.
Of course. I can empathize with that too.
Yeah.
So is it fair to say that when you're talking about the clients that you have, where the management team is in place, ostensibly that's not a problem. Implicit in that statement is that management team possesses the culture required as prescribed by the founder.
That's right. Or sometimes key personnel create culture. It's not always the founder that creates that culture. The founder may create an ownership culture, and those other owners or quasi owners or whatever you want to call them may create that culture.
Sure.
Yeah.
So when you're dealing with business owners, there's obviously, and I think you kind of touched on this already, a sense of pride, obvious sense of ownership.
Mm-hmm.
I might go so far as to say maybe a bit of arrogance and ignorance, right?
Yeah.
And so what's been your experience on that front, where maybe you have the business owners come to you in a sort of an amorphous sense, they believe they need help, but then when you start making particular prescriptions, you start butting up against their ego, right? And false beliefs. Like, what does that look like? Or is that not a thing?
So I am trained in sales. And, you look for, generally in a business, there's just like what you see, there's gobs of opportunity. And generally part of the systems that they've set up are preventing that opportunity from being realized. And so it's not always that you can see, or they can see, or you can make clear to them that they're doing things that they're losing money on. As a business gets larger, so what makes a business worthwhile, right? Well, worth money. Scale is one of it, right? Sort of redundancy, in other words, that's management. I'll call the third thing, financial engineering, right? A lot of businesses are very successful in spite of the fact that they don't run financially a very good ship. And I don't mean a tight ship or whatever. I mean, they're not really running their business financially like they could. So you take two businesses that are construction companies, for just an example, they only trade at 3.5 times earnings, right now, 4 times earnings, because it's cyclical. But you take the one that's got, so they're both doing $100 million in revenue. One's got $40 million of debt and the other one's debt free. The debt free guy thinks he's brilliant. But
yep.
What are you gonna do? What are you gonna do with that? The one with the $40 million of debt has a lot less at risk. He's got $40 million sitting on the side somewhere else making money too.
Yeah.
And that's what people don't realize is that that engineering, calling it financial engineering, financial planning for a company is critical. Part of that financial planning is the tax picture, the tax picture. And then another big part of it's the medical picture. It used to be that employment was the number one cost and facility was the number two cost for most brick and mortar businesses. And now it's healthcare.
Mm-hmm.
So that's become something to be strategic about, but most people aren't. And not just strategic, cultural about. In other words, what can we do culturally for the healthcare of our business, the healthcare of our employees? And businesses are starting to understand that, but large businesses have a big advantage over smaller ones because they're taking initiatives in that area.
One thing I want to touch on, you mentioned it, it's come up a couple of times, is tax planning, right? And so on the exit, you've talked about opportunity zones. We can talk about that, but what does that look like? I mean, obviously there are federally sanctioned vehicles that allow for tax advantaged plays. But is there sort of a general philosophy that governs how you approach the tax component?
Yeah. So if you go into a tax planning scenario with the goal of reducing taxes and nothing else, you're going to wind up at risk, both from the government looking into what you're doing, as well as things just not working as well. But if you understand that tax benefits come from sets of facts, okay, like so if the business has a management company in place, a management services organization in place, there's good enough size, that management services organization may charge a deductible fee to the regular business. And that management services organization may be needed because it manages more than one business or more than one entity. And that can be a tax savings vehicle. So you marry a need for tax savings to a need for some other fact pattern that needs to be in place, a management company, or there's an insurance perspective that needs to be in place. I'll just think about your business for a second. You've got risk there that some of your risk is covered by the insurance you buy, and some of it's not. And same with my business. And so you can do a self-insurance program for some of the risks in your business and get some significant deductions now for taking on that risk yourself. Well, you already are taking on the risk, but for insuring that risk with a company that you set up yourself, it's owned by you or your company. It's called a captive insurance.
Captive. Yep.
Yeah.
We do that. Yep.
Yeah. Very, very valuable and very tax efficient. You may have in mind benefiting a segment of the population that's less fortunate than you. And if you are willing to do that strategically, you can do it in such a way that it creates more cash flow than you actually gave up in benefiting that, or with charitable trusts and things like that. Wealthy people in the United States have been doing that for years. And so those are kind of the three, 2 or 3 big areas that you can focus on to reduce tax. Setting up your own medical plan that's, something like what Amazon does for their folks, can be very tax advantageous, and as well as impact your medical costs. If you're a big company, that medical cost is becoming an issue. It's a bigger issue when we're in downturns than where we are recently, but there's a lot there, and capital gains are very optional. And now that there's opportunity zones available, even liquid opportunity zone fund is available, you don't have to pay capital gains, not the year you sell anyways. So
sure.
I
appreciate that. Like that's actually really encouraging, because when most people, again, you're obviously brighter than the average bear. But again, when you're talking to your run-of-the-mill financial advisor, even family offices that are sort of pseudo-sophisticated, like, oh, we're going to buy opportunity zones. And like, that's it. That's their tax play. Right. And they lose way more in a shitty fucking real estate fund than they'd ever offset with tax savings. Right. So yeah, I'm glad to hear, it's refreshing to hear utilizing various captive insurance plays and all charitable trusts, other forms of trust that you can utilize and take a more holistic approach as opposed to, that's what I was driving at. And I'm glad to hear that answer. That's
I'll give you a cool thing we're doing right now. We've got a client who just sold was trying to save taxes on $12 million of his exit, and we're putting that 12 into a liquid opportunity zone fund. We know it's a crappy investment. It's not going to do much. It may go up, it may go down a little bit. It's probably going to sit there and not do anything. But we can take 6 million of that 12 via leverage and buy something kind of cool.
Yeah.
You know, and now he's making money. He's not paying taxes on 12 million. So he's saving $2.5 million in taxes. And now we've got 6 that we can grow pretty rapidly. While we get rid of that 12 that's in the opportunity zone over time, as we start to pay those taxes with either pay the taxes over time or never pay them if he passes away. He's an older gentleman. But you know, there's interesting stuff you can do if you're willing to put all your problems in one bucket. You know, he needs income, he needs growth, and he hates paying taxes. That kind of guy. You know?
I love him. Yeah.
Yeah. Yeah. So
yeah, I very much appreciate that. Again, just there's a common theme amongst the people that we talk to, right? They're all bright. They all really care and have the intellectual capacity to develop bespoke solutions that optimize the reality and the constraints that people deal with. And you're no exception. It's great to, you know, have a conversation and to be engaged with somebody like yourself on that front. So how did you arrive here? Right. So now you've got a successful practice, but you just didn't pop out one day and sort of here it was. What was your evolution like? Where did you start? How did you get to where you are now?
Yeah. So I started out with a insurance and financial planning group specializing in executive compensation issues. And, you know, I was looking at it was a rough time here in Austin, early 90s. Texas was coming out of a depression basically. And most of the folks that I knew, you know, I had no connections or anything like that. So there was a couple of people I worked for that were installing executive comp, not what they called non-qualified plans in mid-market and larger businesses. And I realized that small businesses didn't have those things. And so I went and started bird dogging for them to bring them into my client, into people I could find as clients. And I didn't find very many at first, but I learned that business. So basically I became adept in the executive compensation world. Luckily for me, Clinton was president and they passed OBRA 93, the Omnibus Budget Reconciliation Act. And what that did is it lowered what people could put away in their qualified plans, 401ks and pensions, et cetera. And so it made all these executives have to do something different. Mm-hmm. And I just happened to be doing that. And so my business mushroomed. And I was sitting with a client and said, now we got that figured out and we got my key people tied to the business and they got a good reward program. Can you help me sell this business? I've got a buyer and I'm like, I don't know what I'm doing. You know, got to be nuts. After about the 4th guy asked me that same question, I thought there's a market here. Even I can figure that one out, you know? And so, and as we went through a couple of exits and I just sort of handheld them through what I knew, the tax, when you're in executive compensation, you learn taxes.
Sure.
So, so that just sort of evolved. And those folks that were selling the business were like, well, now you're going to manage it because you're managing our executive comp. Why don't you manage my money? And I didn't, frankly, feel comfortable doing that and didn't realize, well, it's the same principles. I suppose we'll do it. I just don't know what I don't know. But we started managing money. And that's kind of how it grew from there. And then sort of taxes went down a little bit. Bush became president, taxes went down a little bit, and people kind of thought they didn't want to defer anymore. Executives were doing less deferring. It was a myth, but that's what happened. And so, but more people were worried about income taxes in general. And I decided to learn all I could about philanthropic planning. Mm-hmm. And thought that would take 90 days, and it took 2 years.
Of course,
and I got very involved in setting up charities. And so I would say that probably 80% of our clients have some kind of charitable philanthropic fund or trust or something, because it's very rewarding in lots of ways. I mean, financially, not least of all. So it's kind of evolved from there. And we've evolved into a company. I've evolved into an advisor who's a high-level advisor for businesses on all areas, touching on all areas of their wealth. And an area I stay away from is the psychology of heirs, which I got involved with a little bit and backed out after drama that causes.
Elaborate on that a little bit. I think I know what you're describing.
Well, you know, I love spending time with founders and people who take responsibility for their situation. Your typical heir is not in that. You know, there's just so many things that money brings in the way of problems for next generation folks that are unresolvable by the psychology or the mental makeup those people show up with.
Sure.
Many times. In a great family that has 4 kids, 3 of those kids are doing well, and one of them is a problem. Mm-hmm. In a family that's not functional, it's the opposite.
Yeah,
Screwing each other and all those things. And the thing is, I don't tell them I can help their problem, but I tell them a wealthy family, look, if you don't do planning around this stuff, you know, set up trusts and things like that, you can make a functional family dysfunctional. You cannot make a dysfunctional family functional with any degree of financial planning, but you can do the opposite.
Sure.
So risk management, and the biggest risk is the well-being of those heirs.
Carlos, great talking with you, and look forward to working with you going forward.
Yeah, likewise, very much. Good to talk to you too. Thanks.